Today we're looking at the S&P 500 in front of the July Fed meeting right before some of the biggest companies in the world report earnings. And at the end of the video, we're going to break down the most instructive S&P 500 chart that we follow. So we're paying close attention to the short-term work, but we also have to understand what the long-term trends are as well. And that's where we're going to start today's video. And so this chart is a weekly chart in log scale of the S&P 500 and has a number of weekly moving averages on it. 13-week moving average in green, which really just is 1 quarter of action. 26-week in blue, which is of course 2 quarters of action or half the year. And then a 40-week moving average, which really lines up with the 200-day to give us an idea of what's going on. And so most recently, as we know from the October 2023 low, the S&P has been trading above all of them most of the time, and it only closed below the 13-week in green just one time. It's been a few weeks below it in April, but only actually closed below it just once. And then from that point, the S&P tested the green line again at the May low, and most recently just once more last week, right before the rally toward the end of it. And so that tells us so far, from this perspective, the long-term trend has yet to be challenged. This gives us a very good perspective of how things played out from the 2020-2021 rally into 2022. Needless to say, the best markets spend most of their time above all these moving averages, and each of them sloping higher. And for the most part, staying above or oscillating between the 26-week and a 13-week and going above both of them is the best case scenario. As we can see, as things started to change toward the end of 2021, the S&P kept on revisiting the 13-week more often until it eventually broke below it. And then the most important part of that is when those lines started to roll over and intersect each other. And we know what happened from that point. The S&P then had trouble getting back above all of them. So one thing that's really apparent over the last number of years is that the S&P has been trending, right? Obviously, mostly in an uptrend, but in a downtrend as well, where that means is we can take our time and try to catch these biggest turns and not try to jump in front of it before it happens. And that's really just seeing the S&P roll over potentially these moving averages, and more importantly, seeing those start to curl over and intersect each other again, right? So that's big picture. So if things start to really unfold or unwind at that point, we're going to see it reflected in here, but again, not right away. And so zooming into the 20-day moving average, this is very important because it's not too short-term that it gets intersected a lot. And in the best markets, we know the S&P trades above it for an extended period of time. And also, it's the middle line of the Bollinger Band. So it's pretty significant from different angles. And so recently, no surprises, have been below that 20-day moving average, and here in red. And it's been now 4 days so far, working on 5, which is the longest amount of time since April, and actually the second longest span has been below that line, going all the way back to the very beginning of this rally. So it was actually 17 days before we finally got that rally in early May that got the S&P back above it. Again, it's a big test because, as we know, in the best markets, the S&P tends to stay above the line most of the time, and when it comes down and revisits it, it just acts as a very good short-term buy signal. Now, it's very apparent now over the last 8 or 9 months, but we know this has been different across different periods of time. And just over the last few years, we can see the differences. Whereas in 2020, 2021, again, we see that it didn't stay above the line all the time. And when it did, it just provided another buying opportunity. Not immediately, but as we know, as the S&P has undercut that, found some demand, and then rallied from it, that's been the best time to buy. So that is arguably right now, once more. Where the 2 times that didn't happen, those 2 10% corrections in September and October of during that time frame. But all other times, waiting for really a pullback down to below the 20 days was a very good strategy in trying to buy the dip. Now, of course, that was much different in 2022 when the complete opposite occurred. The S&P spent most of its time below the line, and anytime it went back above it, it was a good time to sell or short into it. That really didn't change until October of last year. So recurring theme we're going to be talking about today is that the market is in a spot where it has supported buying once more. If that doesn't happen, right, if the S&P tries to go back above a 20-day or even fails to even make an attempt, then rolls over, it could tell us that things are changing. looking at the rallies and drawdowns from October 2022 also gives us an idea of where we are and where we have come from here. And so, as we know, there have been multiple sizable rallies over the course of a number of months all along the way. 20%, 20%, 28%, 14%. And the pullbacks have been swift and temporary up to this point. And so right now, S&P is down about 5% from most recent high. Let's put this into some perspective. Whereas it just came off of almost a 15% rally, so 5% of that, it's about a third of a retracement, which kind of lines up with the 38.2 retracement, as we know from a Fibonacci perspective, which is a normal retracement within a big move or a bigger move. And that compares to the 6% drawdown we know from March to April, which came after a near 30% rally. So the pullback was much less severe in terms of the longer trend back in the springtime, but that was enough to encourage another round of buying and really just gave way to this last uptrend. So from this perspective, this pullback is actually worse than what we saw from March to April. The question is it enough to support another round of buying, or is the monster rotation that we've seen going to change that? That's going to be one of the things that I think will be revealed over the next week and a half as we get through these next few very important macro and micro data points. So now looking at the very short term, looking at this 2-hour chart, which we bring up many times, showing the same type of thing where these rallies have been occurring every few weeks and been between 4 and 7% each time. They share a number of characteristics, which has been that we've seen higher highs, higher lows. The market continues then to regroup and do the same thing over and over again, where that same type of thing has been rekindled after rallying from the April low. Now, on an indicator basis, again, 2-hour chart, 14p RSI, almost every time we saw one of these rallies, it produced an overbought reading in the very short term, whereas the pullbacks have either led to oversold conditions or close to oversold conditions, which, as we know, are also very short term and actually led to the best buying opportunities. So once again, this shows us that we're in a potential scenario which has supported the best buying opportunities along the way. And if that fails to play out this time, it could tell us that maybe we're in for a bigger material shift. Not there yet. And we've said this same exact thing every time the market has sold off, waiting for a more substantial pullback to develop. We know that really hasn't happened just yet. So there are a few potential patterns we'll be looking at from a very short term, and they're both on the 2-hour chart as well. So first is a potential bullish pattern. And as we talked about here, where that July 8th was very important because that was the last time that we had a bullish upside target hit. And so we've been operating really with no short-term bullish patterns in the market since that time, which is a pretty long time span for that to occur, considering where we have come from and knowing that we've had 8 successful bullish patterns up to this point. And so this still has a lot to go for this particular iteration to play out, but anytime we see a pullback and a hold, the next step is, as we know, to create some sort of higher low to then leverage. So if that were to play out like this is how it would look. Now, this same chart, the same 2-hour chart, we can frame it differently and it will look like this. Whereas the most recent rally over the last few days, all it did was right now was really crystallize what could be a potential right shoulder of this, bearish pattern. Now, we know how we talked about this in the past. We've had bearish setups like this, and they've all looked ominous, but only a few have played out, and not one of them has seen its downside target hit, going all the way back to October 2022. So it takes a long time sometimes for these to form, and by the time they've actually tried to break down is when demand has come back into the system. So it may be difficult to see this play out anytime over the next few days or so. So the question is, what are we looking at as a guide? And so it's something that hasn't happened since last September. And we've shown this chart before, and it's obviously one of our favorite ones. It's looking at the trading boxes. So what hasn't happened since last September is we haven't had 2 straight trading box breakdowns since then, right? We saw the one in August and again September, which then led to the worst part of that summer to fall sell-off, which was in October of last year, right? And so we saw when the one we saw breakdown in April occurred, we had this colored in green as well, waiting for the next transition to take place. That didn't happen, and as we'll recall, this whole thing right here was an even bigger potential bearish formation which never played out, and then finally got the upside resolution. Let's not forget that back here, it wasn't guaranteed this was going to hold. In fact, many people thought we were going to break down. It wasn't until we got that upside break when things really started to take off. And also, back here, it seems obvious that we're pulling back and which led to an 11% pullback. But if we, zoom out a little bit more, remember that all of this came after 4 successful trading box breakouts on the way up. So the point being is, even though the market was rolling over here, there were a lot of doubters thinking that this was actually going to break down further until we got it based on where we've come from here. And now the same type of thing. There's a recency bias in here. There's people that think that this uptrend is going to continue regardless. And of course, the other side of it is that we're way overdue. And so we try to look at the long term to give us some perspective, realize that the short term is going to give us some clues along the way. But bigger picture, it's all about what the market does with these consolidation periods along the way. Because as we can tell, yes, the market has been up a very good amount and it seems like straight shot higher, but along the way, it's really been about digesting a big run, regrouping, and breaking out again. When that stops happening, that's when the momentum shift will come, and we'll be watching all along the way. That's it for today. Check out these videos and subscribe, and talk to you next time. Thank you.